So whether you're a seasoned market participant or just someone starting out, understanding these 6 tenets from the Dow theory will be a game changer for your participation within the markets. Now, I encourage you guys to watch this video in its entirety because by the end of this, you'll have a clear understanding of how to navigate the complexities of the markets with confidence. So what is the Dow theory? The Dow theory was developed by Charles H. Dow in the late 19th and early 20th century, and this is a foundational framework for technical analysis. Now, while the Dow theory is over a century old, its principles remain highly relevant, and the core tenets provide timeless insights into market behaviors and help make informed decisions even in today's complex financial landscape. And this is because the fundamental concepts of trend identification, market psychology, and volume analysis are all applicable today as they were when they were first introduced. Now, one of the tenets in the Dow theory is that the market discounts everything, and all available information, including past, current, and future events, are already reflected in stock prices. Also, the idea is that market prices adjust rapidly to new information as it becomes available. Now, a great analogy to go ahead and think about is a famous restaurant. Everyone knows it's great, so when you go there, you expect it to be crowded and expensive. Similarly, everyone knows about a company's performance and prospects, so the stock price reflects this shared knowledge. So in essence, the stock market is like a auction house where all known information is already factored into the prices and new information causes immediate adjustments, and this makes it difficult to find bargains or deals because the prices reflect what everyone knows and believes about a stock. Now you may say, whoa, hold on, wait a minute. How is it that you're able to identify and look for alpha, or in other words, find profits in a market if everything is already discounted? But the idea that Dow had was that the market is a barometer that measures the level of optimism or pessimism that investors have about the future. And with that, there's often times where there are irrational behaviors and market overreactions that take place where savvy investors can go ahead and exploit these inefficiencies. So an example of this would be like a tech company, which we'll just call XYZ. Now, let's say XYZ is a leading technology company and it recently announced its quarterly earnings, which slightly missed high analyst expectations due to a temporary supply chain issue. And despite solid revenue growth and a positive outlook, the market reacted sharply and the stock dropped 20% as market participants panicked. And so, recognizing this overreaction, you analyzed the report and you saw that XYZ's fundamentals were still strong. And so, seizing the opportunity, you buy shares at the reduced price, and over the next few weeks, as the supply chain issues end up getting resolved and the company's performance remain robust, the stock price recovers, resulting in a substantial profit from this timely, decision to go ahead and enter when everyone saw the earnings report go down and had that panic fear. Now, another tenet in the Dow theory is that the markets move in trends, and there's 3 separate trends. You have the primary trends, and these are the long-term movements lasting from a few months to several years, indicating the overall direction of the market, bull or bear. And then you have the secondary trends, right? These are corrections within the primary trend lasting from a few weeks to even a few months, and they're often seen as counter movements within the primary trend. And then lastly, Dow had mentioned the minor trends, and these are short-term fluctuations lasting from a few days to a few weeks, and this is usually the noise within the larger trends. Now, Dow emphasized that you shouldn't really participate in focusing into the short-term trends, and that's kind of what you see a lot of times with day traders, but oftentimes someone who only day trades is someone who doesn't really last long participating in the markets, as there's a lot of noise and there's a lot more opportunities to get shaken out and obviously have a lot of losses. And that's why Dow always kind of emphasized on focusing on the primary trend. And of course, I'm not saying that you guys should only do whatever Dow says. Of course, we're just kind of going through the Dow theory. but essentially there's some wisdom in some of the words that were written in the past. And one of the things I like to do is focus more on, my long-term portfolio, and occasionally I have some, rotation in the long-term portfolio. I do swing trades, and then very few times, not very often, I do some day trades, as there are opportunities you could take advantage of in the short term, but it's not recommended to just be a day trader primarily, right? I think everyone should at least have a long-term portfolio if you're going to be day trading. I don't recommend someone only day trade and not even look at investing at all, because again, investing and trading are two separate vehicles. But you have a lot of individuals now, especially with the advent of the internet, and a lot of content out there, who are only focusing on day trading, and that's something that Dow was not really fond of. It's more of looking at those longer trends, and of course moving your positions based on the primary trend and occasionally on the secondary trend, but not really much of someone who is focused on the short trends. But going over to another part on the slide deck, we have this quote here from Dow, Charles Dow, saying, "A trend is assumed to be in effect until it gives definite signals that it has reversed." And this is kind of alluding to the old adage that the trend is your friend until it bends, right? It kind of stems from some of the wisdom that Dow shared in the past. But now another tenet within the Dow theory is that averages must confirm each other. Now, he goes on to state how consistency across indices is important, right? If one major index is signaling a new trend, other related indices should also reflect this trend. And this helps avoid false signals, where confirmation helps in avoiding false signals that may arise from the movements of just one single index. Now, back in Dow's time, he would go ahead and confirm, the averages by looking at the industrials and the transportation average, as in his view, those would move in the same direction, because if transportations are productive and moving goods, then naturally the industrial sector would be productive and there'd be a lot of distribution, and that would have a lot of positive activity. And so, of course, that's back in Dow's day. Now, if we wanted to take a look at this in kind of like today's modern times, one kind of way or pair that you can look at, especially if you're focused on AI, would be looking at something like the NASDAQ 100 and the semiconductor index, as the performance of semiconductor companies often impacts the broader, technology sector. For example, advancements or setbacks in semiconductor technology can significantly influence tech hardware, software, and also other service companies. Now, we had this quote from Charles H. Dow sharing how a trend is considered valid when it's confirmed by multiple indicators or averages. And this is why within the Push and Profit Private Group, I often mention the concept of waiting for confirmation. This was something that originally was pioneered by Dow, but it's something that's still used today, waiting for confirmation before ultimately just jumping the gun or jumping the boat into making a decision. But moving over to the next tenet, we have volume, which Dow shared how that confirms the trend. Dow believed that volume was a crucial indicator that confirmed price trends, and price movements accompanied by high volume are considered more significant and reliable. And we have this quote from Charles H. Dow stating that volume is the fuel that drives the market engine, confirming the strength and direction of price movements. And again, even in today's modern financial landscape, paying attention to volume is something that could be crucial to understanding the directional move of a particular security. Now, I want to go ahead and pan over to just a screenshot of Tesla over here. So we have here Tesla, which is highlighted with the candle bars moving up. And this was a week, or I think it was a span of 2 weeks actually, where Tesla moved up nearly 40%. Now, you see on the bottom side, we had the volume spiking up. And so we have a lot of positive volume taking place as Tesla had a significant move to the upside. And then also on the right hand side, this is more of a modern concept, but this is volume relative to price, and we have little volume relative to price. And I always say within the Push and Profit Private Group, I often share it in these public videos here on YouTube as well, how when there's very little volume relative to price, if there's a lot of buying taking place, that means that there's going to be a lot of movement pushing up the order books, and that's why you see huge spikes upwards. And similarly, if you have on the inverse, a lot of selling with little volume relative to price, you're going to end up seeing a lot of, moves down, kind of like the stock plummeting pretty fast. And so that's kind of like a good way to really view the markets. Again, back in Dow's time, he didn't really talk about volume relative to price. That's something that's more of a modern approach, but he definitely spoke a lot about volume relative to time, which is the bars on the bottom. Now, going back to the screenshot for Tesla, I want to go ahead and clear up a couple of things to avoid any confusion, because someone may ask, well, how is it that you could have a lot of volume relative to time that's positive, pushing a stock upwards, but at the same time have very little volume relative to price, and that also means that a stock could push upwards? And I want to go ahead and kind of just clear this up, right? Because when the stock rises sharply, most of the trading volume was concentrated within a short period of time, and so this creates that high spike of volume relative to time. But during this rapid price increase, the price didn't stay at a significant level for long, and that's resulting in lower volume accumulation at individual price levels. And so the price moved up quickly through different levels, meaning that there was not much time for significant trading volume to accumulate at a signal price point. And so traders or market participants were actively buying at the price, as the price increased, and that led to high volume over time, but spreading the volume thinly across many price points. And so that's again why you see here in the screenshot, a lot of volume relative to time that's positive, Tesla pushing up, and then also little volume relative to price. And so that's why I often focus on volume relative to price, which is kind of more of a modern concept, but as well as the concept that Dow introduced, which was looking at time or volume relative to time, and just using them in confluence to have a better picture. And that's how you have the screenshot for Tesla, where I called out a couple weeks ago, or back when this move took place, that Tesla was going to have a significant rise. It's not, again, that you're predicting the market. When you're looking at the markets from a technical perspective, you're just kind of forecasting and seeing what's going on with the activity. Are there a lot of buyers? Are there a lot of sellers? And of course, if there's a lot of buying taking place, it's just basic supply and demand. There's going to be a lot of demand, which is going to drive the prices upwards. And that's kind of one of the ways that we use technical analysis and kind of, embed it into how we evaluate markets. Now, of course, there's several other data points that you want to be mindful of, but for the concept of this video, we're just focusing on what Dow viewed was important, which is, of course, just, looking away from the fundamentals and kind of just seeing the picture based on the technicals. But going to another tenet of the Dow theory, Dow believed in only using closing prices, as he believed that the most important price of the day is the closing price, and that's because closing prices provide a clearer picture of market sentiment and the consensus reached by market participants at the end of the trading day. And that's why Dow pretty much only focused on line charts. Now, again, line charts aren't as popular now. We have candle charts or candlesticks, which of course have been way before Dow's time, but we use it, or it's more popular in the modern market as it has more data. But if you're ever trying to get a clearer trend of what the market is doing, I suggest toggling over to switch it to a line chart so that you could easily interpret what's going on by just looking at the closing prices. Now, the close is actually something that we see still taking place today, where a lot of large financial institutions, or let's say hedge funds, a lot of mutual funds, etc., they oftentimes buy at the end of the day, the last hour. They call that power hour, and that's because they're looking at what the price settled at the end of the day after all the noise took place with the people who are participating in the intraday trades. And so that's why a lot of larger institutions make trades towards the end of the day, which is just a quick fun fact. But going over to another tenet of the Dow theory, he mentioned how trends persist until a clear reversal occurs. And so he mentions how reversals are often marked by specific patterns or indicators, such as a break in key support or resistance levels, or significant changes in volume and price action. He goes on to also share how trends are driven by underlying market momentum, which is fueled by investor sentiment, economic factors, and broader market dynamics. So it wasn't that Dow ignored the fundamentals, or it wasn't that he ignored the macro picture. He was just using the technicals to go ahead and help, tell the story of what's going on. Now, of course, I think personally, right, and this is just my belief, right, is that you should still be mindful of what's going on fundamentally and from a macro perspective, and look at how it's playing out from a technical perspective and use everything in confluence to have a better idea. But of course, you have a lot of market participants who only focus on the technicals, and it's not bad, it's just one data point. And oftentimes, I just believe having more data is more advantageous to having a better outlook of what's currently taking place. But Dow believed that, look, the price action, the study of the price tells you what's going on from a macro perspective or a fundamental perspective. And that's something that, is pretty interesting, right? Because, I mean, again, he was one of the people who introduced the idea of, he's basically the grandfather of technical analysis. And of course, there's been so much that has been built over it, but nonetheless, definitely something that's pretty interesting. But speaking of interesting, if you found any value in today's video, make sure to hit that subscribe button. Check out the links in the description below. And before you guys go, check out this video right over here where I talk about line charts, as it's a great video to kind of visually see how line charts could help identify trends.